The goal of this presentation is to assess the current state of the economy as well as outline our policy proposal and its defense. First off, we will cover the components of GDP and the recent developments in inflation, housing, and the financial markets. After this, we will discuss the current policy and argue that further expansionary policy is not necessary.
To start, the U.S. economy has been expanding moderately with real GDP growing at a 2% annualized rate in the third quarter. This is an increase over the 1.3% seen in the second quarter. Looking at the month of October, the PMI index and industrial production numbers indicate that the manufacturing sector is sluggish but still remains within expansion range. While the economy is growing, there still exists significant slack. Capacity utilization for total industry as of October was 77.8%. It's been inching up slowly, but still below its historic average of 80.4%. The labor market continues to be weak, but the rate of unemployment has inched down in October to 9%, and the U6 comprehensive unemployment rate has shown a similar trend.
Due to the existing slack in the economy, the rate of inflation has been subdued. The inflation measured by core PCE in September registered in at 0%. Looking at core CPI, in October it only inched up 0.1%. Now if you look at the annualized GDP deflator, you'll see that for the third quarter it was 2.5%. Going forward, we believe that the inflation rate will remain subdued. The inflation measured by core PPI, which tends to lead both CPI and PCE, has slowed in recent months. Moreover, looking at the tip spread, one can see that expected inflation is quite low for both the 5 and 10-year horizons.
We will now look at the components of aggregate demand, starting with consumption. Real PCE has grown 5.2% in October after a 0.7% decrease in September. Retail sales have also increased close to 7% in the month of October. This shows a major growth in consumer spending, which is further supported by the declining personal savings rate. This increase in consumption may be partially caused by an increase in real wage of 2.3% since the beginning of 2011. Furthermore, both the household debt-to-service ratio and the financial obligations ratio have continued to decline, putting the consumer in a better position to spend. Even though consumer sentiment remains low, we have seen a sharp incline from August until recently. This data suggests that we can be rather optimistic about the consumption outlook.
We now turn to the housing market, which remains weak but is mildly improving. In the last 6 months, prices have inched upwards, but they do still remain low. Existing home supply is putting added pressure on these stagnant prices with over 8 months of supply in the market. But to put this in perspective, in October of 2010, there were over 12 months of supply on the market. Recently, it appears that new home sales have bottomed out and have actually inched upwards recently. This data suggests that the housing market is improving, but does remain sluggish.
The weak housing sector has led to stagnant growth in residential investment. In contrast, we see non-residential investment on the rise as an increase in expenditures on equipment and software show. We attribute these increases in equipment and software to a rise in corporate cash flows and earnings, as shown by BEA data. Also, new manufacturing orders increased in October, which lead us to believe that non-residential investment will continue to rise.
Great uncertainty in future federal expenditures and revenues are acting as a significant risk factor. According to the CBO, spending cuts that came out of recent budgetary and deficit debates were in the range of 0.2 to 1.3% of GDP per year over the next 2 to 3 years. The failure of the supercommittee triggered automatic spending cuts of $1.2 trillion, which are likely to have a direct effect on GDP come September 2012. The last component of GDP is net exports, and our trade deficit increased over the first half of 2011, but at a decelerating rate. Counterintuitively, the dollar has been depreciating against other major currencies, and thus we may be able to attribute this increase in the deficit to the J-curve effect. Now, it may be too early to tell, but improvement in the trade balance since June is encouraging and could signal the J-curve effect fading. And if that is so, we can expect to see further improvements in the trade balance. However, a slowdown in global recovery could prevent further improvements in our trade balance.
This uncertainty in Europe is also having adverse effects on U.S. financial markets. Markets have been swayed by daily reports on European debt problems and U.S. fiscal challenges. The VIX started to rise in late July, coinciding with the debt ceiling controversy, and has remained elevated ever since due to the deepening of the European sovereign debt crisis. Bond yields and mortgage rates have continued to decline, showing continuous easing in these markets. the yield curve continued to flatten through late September, steepened somewhat in October, and has recently flattened again. This shows a great deal of uncertainty in both future economic conditions and Eurozone problems. Therefore, we will have to carefully monitor ongoing developments in Europe and monitor for downside risk.
In summary, the economic recovery is on more stable ground, as reflected by a rise in consumer spending. We see inflation remaining subdued, and we don't expect any significant increases in the near future. The housing market also remains weak, but is showing some signs of recovery. Significant downside risks still do exist in Europe and with our own government's fiscal situation. Going forward, we expect a moderate recovery, albeit vulnerable to adverse shocks.
Before we present our policy recommendations, let us summarize the Fed's current policy positions. The Fed will keep its target historically low federal funds rate at least through mid-2013. In addition, Operation Twist, which started in September, aims to lengthen the average maturity of the Fed's holdings. Furthermore, the Fed has decided to reinvest the holdings of its mortgage-backed securities. Based on our view of the current state of the economy, we believe that the current policy is suitable and that further expansionary measures are not needed. We will examine the existing policy thoroughly, starting with a discussion on the commitment policy and its exit condition. But then we will follow that with an argument on Operation Twist and the reinvestment policy and why currently they make sense. Lastly, we're going to explore quantitative easing 3 and why additional asset purchases at this time are not necessary and should be reserved for downside risks.
First, we support the current FOMC statement on the commitment policy, which is as follows. The committee currently anticipates that economic conditions, including low rates of resource utilization and a subdued outlook for inflation over the median run, are likely to warrant exceptionally low levels for the federal funds rate, at least through mid-2013. This statement provides a clear time horizon for the policy duration and removes a great deal of uncertainty about the Fed's future course of action. By maintaining better communication with the markets, the Fed will be able to lower federal fund rate expectations, which lowers long-term rates without increasing the Fed's assets. Historically, the Bank of Japan used a similar commitment method in the early 2000s. According to their study, the 5-year government bond yield dropped by 5 basis points, and the 10-year government bond yield dropped by 3 basis points from their commitment policy alone. Consequently, one can assume that the Fed's policy has had similar effects of lowering long-term interest rates.
There is, however, one difference in the policy the Bank of Japan employed, specifically the clarity of the exit condition. They provided a clear exit condition, which was to discontinue the zero-rate policy once inflation became consistently positive. The Fed, on the other hand, is vague, for they do not provide a specific exit condition. Recently, members of the FOMC have publicly supported a clearer conditional statement. Charles Evans, president of the Chicago Fed, has suggested the Fed set specific benchmarks tied to unemployment and inflation. Most recently, Minneapolis President Narayana Kocherlakota has advocated the Fed setting a public contingency plan of how the Fed would react to economic developments. He believes this would, quote, provide clear guidance on how it will respond to a variety of relevant scenarios, unquote. In essence, such a policy will increase the Fed's transparency, remove uncertainty about the exit strategy, and better anchor inflation expectations.
While we recognize the importance of better communication through a conditional statement, there would be some practical problems with implementing this idea. First, the Fed would have to post a specific numerical threshold, such as 2% PCE for, say, 3 consecutive months. This is problematic because from April through August, due to high commodity prices and supply chain disruptions, inflation was already at or above 2%. This would have implied that the Fed should have ended the zero-rate policy immediately as of 2013. Second, adding an explicit exit condition may signal to the markets that the Fed is now more worried about inflation and less about jobs. Third, even if a numerical target were to be employed, it would be difficult to choose a target because the Fed has never chosen a specific numerical target for its dual mandate. Further, confusion may be added because the 2-year commitment was decided just 3 months ago. And finally, since the late 1970s, the Fed has built a reputation that is committed to price stability, and the market already assumes that if inflationary pressures rose above a desired level, that the Fed would act accordingly. To the extent that the market has already priced in such this possibility, the benefit of adding an exit condition would be fairly small.
In conclusion, we do recognize that there may be a marginal benefit in providing an explicit clause that improves communication with the market, but we do not believe it outweighs the cost of implementing the policy. Specifically, It will create uncertainty and confusion in the marketplace and may end up undermining the credibility of the Fed. For these reasons, we believe that the current policy of the low federal funds rate with a time commitment is sufficient.
Moving on, we support the Fed's current policy, commonly referred to as Operation Twist. This policy dictates that the Fed purchase $400 billion in longer-term securities in exchange for the same amount of shorter-term securities. This promotes our objective of lowering long-term yields. And furthermore, this policy is logical because short-term yields are already at the lower bound. If the Fed's commitment policy is credible, then that policy alone is effective enough in bringing rates for up to 2 years for Treasuries up to 2 years to nearly zero. The Fed should continue to purchase long-term securities in order to flatten out the yield curve and reduce borrowing costs.
Operation Twist has been effective in lowering long-term rates. According to Northwestern economist Krishnamurthy and Jorgensen, the MBS market is somewhat segmented, and therefore the purchase of Treasuries may not significantly lower MBS yields. Given the weak housing market, the Fed still needs to provide support. Allowing the amount of MBS on the Fed's balance sheet to fall could be a detriment to the housing market. Therefore, we would like to maintain the current reinvestment policy and monitor both the mortgage and housing market to determine if any change is necessary.
The idea of another round of quantitative easing is brought up quite regularly. Now, theoretically, quantitative easing works through several channels, such as the interest rate channel. When the Fed purchases assets, their yields drop, which reduce borrowing costs. Another is the credit channel, whereby in exchange for releasing assets, banks have more reserves to lend, which should ease credit market conditions. Further, the U.S. dollar should depreciate as more money is injected into the market and should improve our trade balance. And finally, it works through the balance sheet channel, where when the Fed's actions increase asset prices, borrowers' net worth increases, the value of collateral increases, all of which reduce agency costs and should encourage more lending. Now, how to quantify the effects of quantitative easing is a different matter, and for that we do not have a definitive answer. There's limited empirical literature on the quantitative effects of QE, but Krishnamurthy and Jorgensen both argue that QE1 and QE2 were effective in reducing long-term yields, especially on the types of securities that were purchased by the Fed. While their study shows that the interest rate channel significantly eased, we do not have enough empirical evidence that suggests what would have happened to the economy if QE1 and QE2 had not been implemented.
What we do know, though, is that we have over $1.5 trillion in excess reserves on banks' balance sheets. Pursuing another round of quantitative easing and asset purchases would merely add to their success. If you look at the Senior Loan Officer Survey, you'll see that credit standards have been loosening for almost across the board. Specifically, if you look at commercial and industrial loans, they have seen triple-digit growth since the beginning of 2011. With this in mind, we can assume that lending standards are going to continue to decrease and lending is going to be occurring. Given that the credit market has slowly started to recover, quantitative easing is not necessary. We believe that quantitative easing 3 should be reserved for when downside risks present themselves and emerge.
To summarize, the Fed's policy has been extremely expansionary and has been doing everything in its power to prop up the economy since 2008 by adopting non-traditional measures. Meanwhile, our economy, despite some weak sectors, such as the housing and the labor market, shows signs of improvement recently. As the economy seems to be on the right track, we believe that further expansionary policy is not necessary. Hence, we should monitor the strength of the recovery and continue to watch for downside risks both home and abroad. Lastly, we have to remember that monetary policy works with a long and variable lag. This means implementing further expansionary policy to achieve a certain rate of unemployment can be detrimental. By the time the unemployment rate achieves the desired level, the economy may have long passed the turning point. With an improved outlook, the Fed should maintain its current policy and continue monitoring for downside risks. Thank you.
Thank you. Okay. Back to you.
Back to me. Well, much of your discussion, presentation, covered various aspects of recent Fed policy, the various unconventional aspects of recent Fed policy, things that the Fed has done since taking its interest rate target basically to zero. So you come down on this with the conclusion that further accommodation isn't called for at this time. So I'd like you to talk a little bit about specifically what triggers you would look for to make you change your mind about that and say, further accommodation is necessary now. And if you decided further accommodation was necessary, look at this array of unconventional policy tools that you've described and tell me how you would think about choosing among them, which, versus, thinking about the types of communication policies you described, the types of balance sheet policies you described, and weighing the costs and benefits of those different types of tools.
One thing that we talked about in our policy is one of our main concerns to downside risk is the European financial situation, and that would be one of the primary targets we would look to see if a further accommodative policy is necessary. Specifically, if there is it further downturn in economic output and or a financial contagion were to continue to spread.
What we have to look at is the Fed's dual mandate, which is maximum employment and inflation. And to the extent that the European situation starts to affect our unemployment level even further, that's when we would start presenting more monetary and expansionary tools. If you look at unemployment, you'll see that it remains stubbornly high, and thus some people believe that further action should be taken. However, if you look at retail sales, consumer spending, and overall aggregate demand, for the past 6 months they have been improving. So that is our justification for why further expansionary measures are not needed. However, if unemployment remains stubbornly high and then it actually increases, that's when we would start implementing further expansionary policy. And some of these tools, because we're at the zero bound, we have to pursue extraordinary measures, including potentially quantitative easing 3.
We have also covered, in our discussion, we saw that as consumption was growing, but at one point we were concerned with maybe it was too low, maybe the consumer needed more access to loans. So we have looked into term auction lending facilities and such that would help increase loans to the consumer and to the small business, so the small business could provide jobs for the consumer and hopefully help out on the unemployment rate.
We've looked at other mechanisms for banks to encourage banks to lend. They have $1.54 trillion worth of excess reserves on their balance sheets, and it's a lot of money. So we want to get that out into the market. We've looked at various mechanisms to encourage that, but we've determined that overall credit standards have been loosening, and as with any financial crisis, banks tend to overcompensate with their risk perception, and that's something that while we can provide excess reserves and ample liquidity, it takes time to work out of lending standards.
Another possible route we could pursue is pursuing higher inflation. So you've looked at the Phillips curve. You'll see that in the short run, there is a trade-off between employment and inflation. So if we targeted, say, 3 or 4% inflation, the possibility is that employment would begin to increase. So that we could pursue, as Charles Evans has advocated, say 3% inflation going forward. But the bottom line is consumer spending is increasing, retail sales are increasing, unemployment is inching downwards, monetary policy works with a long variable leg, as we stated, and right now we just don't see expansionary measures necessary.
Thank you.
Okay, you mentioned communication and commitment and the dual mandate and setting an inflation target. Do you believe that the Federal Reserve should set an explicit target for inflation and or unemployment? And if so, how do you think monetary policy should react to deviations from those targets?
Well, first off, we recognize that this is a hotly debated topic at this time. In the recent FOMC minutes from November, they discussed both the possibility of an explicit inflation target and an unemployment target.
Currently, the Fed has an implicit inflation target, which is what most would assume to be around 2% or just under that. The benefit of adding an explicit inflation target would be increased communication and a little bit more transparency, but it would also tie the hands of the Fed in terms of some of their discretionary policies that they want to take out in the short term. So adding an explicit clause may add small benefits, but it may limit the Fed's ability to act in the future.
What that also does, though, on the plus side, is that it decreases time inconsistency problems. So if we were to adopt a target inflation rate, it would we would not be compromising short-term benefits for long-term benefits. So there is a positive to pursuing these avenues with targets and specifically mandated situations for the Fed to pursue policy.
The downside to this is it opens the Federal Reserve up to credibility criticism. If the Fed misses these targets, it will provide uncertainty in the market and reduce credibility, and that is something that the Fed has to consider in all of its decisions.
Speaking specifically on an unemployment target, it has been stated that there are some practical problems of implementing such, as because unemployment lags behind other things. By the time we reach the explicit level that is set, we may have passed the turning point on which it is a good policy to exit.
Lastly, with inflation, you'll see if we were to pursue a target rate of, say, 2% or 3%, what measure of inflation are we going to be looking at? And that just comes down to practicality issues. We need the Fed to be looking at multiple variables and then discern whether or not inflation is a real issue or not.
Do we want to tie the Fed's hands in terms of a specific target? Does it become a trigger for things? Does it become a ceiling with an inflation target? It becomes very difficult to communicate that to the market, and with how volatile markets have been, a new operating procedure, a new communication mechanism might be a detriment to the overall health of the economy.
Okay.
So you mentioned Europe as a significant downside risk to the growth outlook. I wanted to invite you to elaborate a little bit more on this, and specifically, I'd like you to tackle it in two stages. First of all, explain what you think is the nature of the crisis in Europe, and secondly, the potential implications of that for the U.S.
So the heart of the issue for the European crisis is that governments are over-leveraged fiscally. There's also the effects of entering the euro on some countries was extremely cheap credit, which has led to capital imbalances. This is first seen in Greece, and it appears to be spreading. Obviously, we know it has spread to Italy, even though Italy is running a primary surplus, which leads us to believe that we may be experiencing the first signs of some contagion effects.
So we look at the way the euro crisis has spread, and that's in two ways. There's been a run on European sovereign debt in terms of Greece and other countries, which has made their interest expenses spike and made it very difficult for them to roll over debt that they've incurred while credit was cheap. This is because of a completely different risk perception of investors. And then we also see a run on European banks, which is really what's causing the contagion effect and the spread of this crisis to other countries such as Germany and France. The banks in Europe are exposed to sovereign debt from Greece, Ireland, all the PIGS countries, and that worries investors, especially institutional investors. This has caused long-term bond markets, money markets, and the interbank lending market to dry up, as we've seen about 43% of liquidity provided by the U.S. has dried up in recent weeks. So we look at this as an imminent problem, and that's because we've started to see capital controls and and capital outflows from the weaker countries, and this is reminiscent of the Argentine crisis in the early 2000s, which is why we think this problem needs to be resolved very quickly, or it could have detrimental effects to the entire European economy. There's absolutely a relationship between the real economy, banks, and the government in terms of if banks have to sell assets to raise capital, to become more liquid, there will be a credit crunch similar to the one we experienced in 2008, which will lower aggregate demand and cause government revenues to go down, which will in turn hurt their ability to meet their fiscal obligations.
And let me clarify one point. We haven't yet seen capital controls. We've seen signs of them, and we point to a new Wall Street Journal article today with some European governments asking their banks to refrain from selling the government loans. That's what John was referring to.
Now, all this would have adverse effects on the U.S. economy. The IMF has recently downward revised the GDP growth projections for the global economy, especially those in Europe. Because the Eurozone is 20% of our exports, that would cause our exports to decrease to them, which would hurt our GDP. There's also the financial risk and the risk that our banks hold to the European sovereign debt as well as the off-balance sheet risk that we don't need, and the debt from the shadow banking system that could have an impact in our own economy.
But if you look at Timothy Geithner's statement, which he made to Congress a little while back, he said that financially we are not that exposed to the European crisis, and that banks, compared to the 2008 crisis, are much more well capitalized. So that is definitely a positive financially. However, we do recognize that the European situation would cause a decrease in our net exports and thus GDP. But the reality is the U.S. can only do so much with the European situation. We can provide communication and direction and advice to our European neighbors, but ultimately it depends on the European leaders and how they're going to resolve their situation.
Thank you. And would you care to elaborate any further on your discussion as to what the underlying roots of this problem were in Europe?
Sure. So it's essentially the over-leveraging of these countries' balance sheets. They are spending much more than they're taking in. And as these countries become so over-levered, there's the possibility that they're not going to be able to pay back their debt obligations. And when that becomes a possibility, then their interest rates and their borrowing costs go up and merely exacerbate the problem.
So when these countries joined the euro, they became monetarily integrated, but they didn't become fiscally integrated. We saw creative accounting by governments such as Greece in terms of hiding their debt and what the amount of their fiscal obligations are. And because their monetary policy isn't independent of their fiscal policy, because it is independent of their fiscal policy, that creates a problem in terms of inflating debt away or other avenues which we've seen throughout history that governments pursue when they become over-levered.
And one fear that we're seeing financial markets attribute to this crisis is the fact that of austerity measures, and that being that tighter austerity measures to get these countries back into fiscal order can actually lead to a severe contraction and actually make it more difficult for these governments to reform and pay off their debt by having lower tax receipts from lower aggregate demand in their countries.
It's all starting to turn into a self-fulfilling prophecy at this point.
Thank you very much indeed. You got a little more time?
2 minutes.
All right. I guess let me ask a question that picks up on something that you talked about early in your presentation. What's the J-curve effect?
The J-curve effect is as the dollar depreciates against other major currencies, we would expect to see our exports increase as these countries can import our goods cheaper. But we don't see that happen immediately because the substitution effect of goods does not occur until later down the road. And it's just a time delay in the balance of our trade balance.
We see our trade imbalance temporarily worsen and then we see it improve later, which is the J-curve.
So that's an empirical regularity you're describing. Why does that happen?
Because businesses, when they plan, they're not. So as the currency depreciates, they're not going to immediately change their business plans and the way that they go about purchasing the materials. And as that currency depreciates dramatically, that's when businesses start to take note of this and start changing the way that they go about doing business. Whereas before, it's more, okay, it went down, it's depreciated a little bit, but we're not going to change anything substantially right away. So there is a timeline between currency depreciation and the way businesses conduct their business.